Welcome to today's Explainer. We're diving straight into the wild, sometimes downright chaotic world of global currency, specifically demystifying Accounting Standard 11. And to make this really click, we're going to follow the journey of Arjun. He's this ambitious, but honestly completely overwhelmed accounting professional. Luckily, he's got a wise ICEI mentor to show him exactly how to tame the roller coaster that is foreign exchange rates. Just picture Arjun's panic for a second. He's desperately trying to keep his company's financial records straight, but the value of the money they're using, it's literally changing every single second. His mentor steps in and asks him this crucial question: how do you even account for a moving target? Well, that exact problem is why Accounting Standard 11, or AS-11, exists in the first place. So, here's how we're breaking it down today. First, the foreign exchange challenge. Second, rules for initial recognition. Third, monetary versus non-monetary items. Fourth, balance sheet date adjustments. Fifth, calculating exchange differences. And finally, number 6, translating entire foreign operations. Let's get right into it. Section 1, the foreign exchange challenge. The ICAI mentor kicks off Arjun's training with one fundamental concept, and that is the reporting currency. See, AS-11 is absolutely crucial because whether a company is shipping goods overseas or running an entire branch halfway across the world, all of those activities eventually have to be translated back into the home reporting currency. Think about it. If Arjun's Indian company is buying and selling in US dollars, they can't just casually slap those dollars onto a rupee balance sheet, right? They desperately need standardized rules to translate those numbers. Which brings us to Section 2, Rules for Initial Recognition. Right off the bat, the mentor hits Arjun with the golden rule. You absolutely must record a transaction using the exchange rate from the exact date that transaction occurred. No guessing future rates, no waiting around to see what happens. You lock in that initial value using the spot rate of the transaction date. This is the only way to perfectly capture the financial reality of that specific moment in time. Moving on to Section 3, monetary versus non-monetary items. Now, this is where things get really interesting. The mentor explains this massive, crucial divide to Arjun. You've got your monetary items and your non-monetary items. Monetary items are directly tied to fixed amounts of cash, kind of like creditors you owe money to. But non-monetary items, totally different beast. For example, let's say Arjun's company buys a machine for $2,000. That is a physical asset. It just doesn't have a fixed, determinable cash value attached to it the way cash sitting in a bank account does. To really cement this, the mentor breaks down a classification table. It shows exactly how this plays out in the real world. Things like trade receivables. They're monetary because they represent a very specific pending cash claim. But what about that $2,000 machine we just talked about? Well, that falls squarely under property, plant, and equipment, making it strictly non-monetary. Okay, Section 4, balance sheet date adjustments. The mentor gives Arjun a serious heads up about the approaching balance sheet date. Because monetary items represent actual pending cash flows, they absolutely have to be updated to the current closing rate. But wait, what happens to that $2,000 machine Arjun bought? Well, because it's a non-monetary item carried at historical cost, it safely stays exactly at its day one transaction rate. It doesn't get constantly revalued just because the global currency market is going crazy. This leads perfectly into Section 5, calculating exchange differences. Let's actually follow a specific scenario the mentor lays out for Arjun to see how all these rules hit the real-world profit and loss. So Arjun's company imports some goods for $1,000. On the day of the transaction, the exchange rate is exactly 80 rupees, but by the time they hit the balance sheet date, the rate has climbed to 83. And it gets worse. When he finally settles the payment, it's jumped all the way up to 85. Let's break down the damage. On day 1, following the mentor's strict golden rule, Arjun records those 1,000 creditors at the initial transaction rate of 80 rupees. So his initial liability is securely locked in at 80,000 rupees. Easy enough, right? But then, bam, the balance sheet date arrives. Because these creditors represent a fixed amount of money that has to be paid, it's a monetary item. This means Arjun is forced to restate it at the new closing rate of 83 rupees. So $1,000 multiplied by 83, his recorded liability just ballooned to 83,000 rupees. The mentor doesn't sugarcoat the painful truth here. Arjun's liability literally just increased by 3,000 rupees, out of thin air. And under AS-11, this difference has to be recognized immediately as an exchange loss, debited straight to the profit and loss account for that period. Even though he hasn't actually handed over the extra cash yet, Arjun is learning a very harsh lesson about how currency shifts can quietly eat away at a business's true economic reality. And finally, Section 6, translating entire foreign operations. For the grand finale of his training, the mentor zooms way out, removing from single transactions to looking at entire foreign branches. He teaches Arjun to classify these operations into two distinct buckets. First, you have an integral operation, which functions pretty much as a direct extension of the home enterprise. Then you have a non-integral operation, which operates completely independently, stockpiling its own local cash and running its own expenses. Now, if they're dealing with an integral operation, the mentor gives Arjun his marching orders for a line-by-line translation. Fixed assets? They get translated using the historical rates from their exact date of purchase. Inventories? You use the rates from the exact moment those costs were incurred. And monetary items, things like cash and receivables, they are translated at the closing rate. This whole process ensures absolute fidelity back to the home office's reporting currency. It's like putting together a giant puzzle. Thanks to his ICAI mentor's guidance, Arjun finally gets it. AS-11 isn't just some boring exercise in balancing books. It's the key to revealing how global shifts silently dictate actual profitability. So the next time you see a massive global company report a sudden, unexpected spike or drop in profits, ask yourself, was it really a fundamental change in their core business? Or was it just the silent translation of monetary items sitting on their balance sheet? Thank you for joining me on this explainer, and remember, always keep questioning the numbers behind the narrative.